Hello, everyone. Chad Frantzen. Welcome to the Kingdom Finance Show. On this week's program, we're going to talk about the economy, the Federal Reserve, and when are we going to see interest rate cuts? That's really the big topic for the markets in the U.S. and the economy as the whole world watches to know when are rates going to go down. And Jerome Powell, who leads the Federal Reserve, has had a lot to say about that here in the last few weeks. Thanks for being a part of the Kingdom Finance Show. Our aim here on the show is to educate you on what's most important in the economy, in the markets, as you think about thoughtful, values-based investing for your family, your companies, the organizations that you're a part of. So let's jump in on today's program. Thanks for being here. So as I mentioned, there's a lot going on in the markets, and I've been doing a lot of research here as we work with our families and organizations that we consult with and advise for at Wealth Builders Investments. And one of the things that we've been talking a lot about, and I wanted to get back on the Kingdom Finance Show to educate our followers on is, well, what exactly is going to happen with interest rate policies? No matter where you live in the United States, everyone's aware that the real estate market is a bit frozen, a bit tepid, as we would say. There's a growing inventory. Prices are still high, but rates are still high, right? And so part of that market is a little bit disjointed. You can't buy a piece of property as a primary residence or as an investor when interest rates are also high for financing that. So, but again, stock market is at all-time high. Gold is at all-time high. Bitcoin has been at all-time highs. It pulled back recently, but there's a lot of strength in different asset classes. So what I want to talk about here on the first part of the show is, well, what's going on in the economic engine of the United States? What's the Federal Reserve doing? What do we think is going to happen this fall? And then at the end of the show, I'll just share with you some of the asset classes we view as good asset classes. Again, not giving you personal financial advice, but just sharing, hey, here's some of the things we're looking at as a firm and some of my colleagues in the industry, what they're looking at from an investment standpoint. Again, wanting to just distill the noise and the news and the markets and how do you make wise, thoughtful decisions that not only align with your personal beliefs, but that are going to be smart for how to manage resources, how to invest in your 401k or in your company's retirement plan and your personal savings for your college or even just with your investment portfolio. Jerome Powell spoke recently. Again, we're recording this the first week of September 2025. Chairman Jerome Powell spoke in Jackson Hole back in August, actually August 22nd. So that's a few weeks ago that's happened. Prior to this recording, and he finally was forthcoming that interest rates would be on the horizon. It's no surprise, or it's not, it's widely known that President Trump is not a fan of Jerome Powell and that Trump would very much like to see a significant interest rate cut to help the economy, along with the other policies that the White House is doing to keep the economy going. And, Powell's term comes up, I believe, next spring of 2026. So we fully expect President Trump to install a new Fed governor in there. Now, that being said, there has been quite a bit of contention within the Fed. There's a board of governors, not to get too technical, that meet, and there's a chairman, and they meet as a board. But as recently as July of this year, 2025, two of the Fed governors had dissented, which means that they actually wanted interest rates to be lowered, even as recently as July. Now we're recording this in September of 2025. So there is obviously discussions going on at the Fed level of some governors seeing the data that we're seeing, which supports lowering interest rates, which would help consumers, it would help small business owners, it would help mortgages and real estate investors, homeowners, and so forth. Now, the Fed does not have a great track record. They have been very notorious for making many policy mistakes. We can go back even to 2018 when it was too late to stop tightening. That was a big thing that was happening. and even in 2020, when it was too late to start tightening in 2021 coming out of COVID, and really just being asleep at the wheel with some bank supervision back in 2023. So, the Fed, although a very smart, intellectual group of board governors, they don't typically hit the mark. They're either too slow or too late. Again, most of us probably don't envy their job, but the Fed is not data dependent, would be kind of point one here. They claim to be data dependent, but the key takeaway, I'm going to share some data here that's just come out with jobs in the economy. Again, when we look at what's the health of the economy, a couple things we're looking at is the economy growing or contracting, and what's happening in the job market. I'm going to give you some data points on that. Again, the Fed has long said that they're data dependent, but it's quite the contrary. If they were purely data dependent, we really believe they would have already cut interest rates. We've seen inflation dip under 3%, and we've seen weakness in the jobs market, which would lead, if you're looking at data, would lead to say that you need to be cutting interest rates. The Fed has a current 2% inflation target. It's very arbitrary and quite frankly dangerous. Right now, inflation for the month of June, July came in at 2.9% annually. I'm going to talk a little bit about that. Again, this episode, I'm really diving into some economics on it. I will wrap up with just some takeaways for us as investors. Again, just things that we're doing that you can research and consider as well. Point number two is that this whole concept of tariffs. Tariffs are not inflationary. Many people believe they are, but let me explain. Tariffs should not be treated as a long-term inflationary component. They should be viewed as a one-time price adjustment. And what I mean by that is you're just leveling off the prices, and it will slow economic growth, but then that cost, that tariff is now built in. It does not extend to sustaining ongoing inflation. The Fed really should not base their monetary policy on inflation. They should be basing it on not the lagging part of the business cycle, which inflation is. It's kind of like looking through your rearview mirror. They really need to be looking at what's going on in the jobs market and the unemployment rate, things of that nature, business spending on that. So again, a lot of people have said, well, gosh, tariffs are going to be so bad. They're actually overall quite positive for the economy. Again, this is not an episode on tariffs specifically, but I want to give some context for, well, why hasn't the Fed moved quicker to cut interest rates? They've been worried about tariffs. The tariff policy we're supportive of, it's actually some post-World War II policies that have been in effect since coming out of the World War II victory by the Allies, that all the other nations look to the U.S. to support them. And so many of those trade policies have not been touched for political reasons until Trump has shaken that up. It's actually a positive thing for that. A little short-term pain, which we saw in April when the markets had a big downturn, but markets are back at all-time highs. Tariff policies are getting settled between the countries, and I think that's very pro-business, pro-U.S. Economic policy there. All right, so again, I talked a little bit about the inflation and so forth. One of the other things, just to be aware of, this week, now we're recording this the first week of September, the jobs report is very important to know about interest rates, and I'll get to kind of what we're thinking is going to happen. The Federal Reserve does meet here in mid-September. We're recording this about 2 weeks before that meeting on that. So this week, the U.S. economy in the month of August 2025 added 22,000 jobs. 22,000 new jobs. That was well below the expectation of 75,000 jobs. So unemployment has gone up to 4.3%. This is the second lowest jobs report going back to July 2021. So over the last 4 years, this is the second weakest one. So the labor market is deteriorating. There's a clear path for a rate cut coming up on September 17th. 2025. We're recording this about 2 weeks before. And I believe personally one more rate cut before the end of this year for a total of 2 interest rate cuts. I'll talk a little bit more about why I don't think there's more cuts than that. The labor market has obviously deteriorated enough to where the Fed will now come out and say, "Hey, we have a collapsing labor market, and this is why we're cutting rates." The reality is the economic job market has been deteriorating for quite some time, but the Fed has not been looking at that. They haven't been data dependent, as we've talked about on that. So that's some significant data. We wanted to wait to get that jobs report before we posted this programming note here on the show. Now, underemployment. Let's talk a little bit about underemployment. So people that have jobs, but they're not fully employed, right? Underemployment in the United States has jumped to a little over 8%. And that's the highest level in 4 years that we've seen. Now you might ask, well, why is this important? Well, it's important because many of these people are not looking for work. They're working, but they are underemployed. So millions of Americans have either given up on their job search or they can only work part-time. So we expect that number of underemployment. It's around 8%. It's going to continue to increase, probably closer to 9, even 10% on that. Now, you can always look at the bond market and things like price of gold. Gold on news of the jobs report has continued to rise. It's when at this time of recording was over $3,600 an ounce. It's up about 40% year to date in 2025. So gold is saying, hey, this is rate cuts are coming. The jobs and the economy are not that strong. And so hard assets like the gold and the silver and even what we've seen strength in cryptocurrencies is really telling us what's happening there. So again, there's been also ongoing job revisions downward where the new jobs that they had or for June and July, they get revised in subsequent months. Those are even reduced. So the overall job market is a mess. And we believe September 17th, Chairman Powell and the committee will vote to lower interest rates by 25 basis points. I think there's looking at some statistics here based on different economists. I think there's close to a 90% chance that we'll get a 25 basis point cut. So what that means, just as a reminder, is the Federal Reserve rate or the Fed funds rate currently is 4.25 to 4.50. So that is not necessarily the rate that you and I borrow at directly, but that is the rate at which is set at the federal level that banks lend on. So we expect that will be cut by a quarter of a percentage point, or we call it basis points, so 25 basis points on that. Now, the Federal Reserve has 2 more meetings after September. They have a meeting in October and they have a meeting in December. Now, I want to talk a little bit about inflation because inflation, going back to earlier in the summer was 2.9%. Now, the Fed says its target is 2%. It's a little arbitrary and quite honestly unrealistic. We do expect most of the research think tanks that we follow believe inflation is going to start to kick back up, expecting it August, September, October to go over 3%. Now, that's not the end of the world, but it is rising inflation. Now, what we call, to give you a term for this, when the economy is not growing and inflation is going up, advancing, we call that stagflation. So stagflation means we've got some rising inflationary pressure and lessening economic growth. Doesn't mean we're in a full-blown recession. That's a totally different terminology. But this is stagflation. Now, so there's different things that business owners, investors, people just wanting to make wise decisions with their resources need to do when we're in a stagflationary environment. So I want you to know a little bit about that. That's really the environment that we are in. That's what gold prices are saying. That's what Bitcoin is saying. That's what the bond market's saying on that. Now, because we see inflation actually ticking back up here going into September, October of 2025, I do think that is going to give the Federal Reserve a pause on how aggressive they are with lowering interest rates. So hear me on this. Although there's a huge contention for lowering rates, half a percentage point, a full percentage point. We think we're going to see a little bit of inflationary pressure this fall, which is going to give Chairman Powell, especially, hesitation to not lower rates too fast. Again, as I mentioned earlier, I think there's a 90% chance that we'll see a quarter of a percentage point cut this September. That's going to be good. It's going in the right direction. Currently at this recording time, I think it's a 50-50 chance that we get a rate cut in October. I would probably think we will not get one, but it could go either way, primarily because of some inflationary pressure. Now, I do think if we don't get a rate cut in October, that we will see an interest rate cut, probably another quarter of a percentage point at the December Federal Reserve meeting. So again, based on the economic data, we fully believe there's two interest rate cuts coming between now, September, and December of 2025. Now, that's going to be welcome relief, particularly for the real estate, the mortgage markets on that front. In anticipation of rate cuts, we've also seen the stock market expand to higher multiples, all-time records. We've seen Bitcoin do the same, as well as gold. So the securities markets have been very bullish in regards to this. Now, this is not looking into 2026. I think the economic landscape will look a little different, potentially more growth-oriented, more rate cuts in 2026. But what I wanted to do for today's show was just talk about what we see happening between now, again, end of August, first week in September, until the end of the year on that. So again, in summary, September rate cut all but assured, but we see rising inflation through the CPI number that will most likely go over 3%, and we think that'll mitigate a rate cut in October. But I do think a second rate cut in December is on the table for that. So let me just share a little bit on, well, okay, Chad, that's some economic speak. Maybe some of it's a little over your head. I get all that. What do I do with that? So the jobs market is slowing. It's not recessionary, but it is going to make the Fed actually cut rates. They probably should have cut rates in July, but we think that that's here now, which will be very helpful. Let's talk a little bit just here in the last few minutes of this program. Well, what does that mean for me as an investor managing financial assets on that? There's several asset classes that when you think about stagflation, you think about rates where they are coming down a little bit. Again, we've talked about Bitcoin and gold and even the S&P 500 and being at all-time highs. Some of the different asset classes that will continue to do well, again, in our opinion, I'm not giving you specific advice. Obviously, happy to visit with you one-on-one and our team if you want specific counsel. But you're going to be looking at some of the tangible asset classes like precious metals, gold and silver. You are going to be looking at cryptos like Bitcoin, Ethereum, even Ripple. You're going to be seeing strong asset pricing in those. Even in the precious metals, whether you're owning the gold or silver itself or owning companies, mining companies, development companies that work in gold and silver. Those are poised to stay strong through the end of this year. Now, the economy is made up of several different sectors, right? There's finance, there's defense, there's healthcare, there's consumers, there's technology, right? All those things, aerospace. So some of the key sectors that, again, in our research and some of the third-party organizations that are much smarter than me that I consult with, we're looking at places like the industrial sector, the defense sector, energy sector. Obviously, the Trump administration, very, very drill baby drill oriented, right? And we like the energy sector, whether we're investing directly in oil and gas development programs with partners, or whether we're investing in companies, public or private, that are doing that. So I think energy continues to be a positive sector, given the economic landscape that we're in. I also think healthcare continues to be a good sector of the economy. Now, technology, there's obviously a lot of big tech names. NVIDIA has, as if you followed NVIDIA at all and what's going on with the AI revolution and the chip movement, AI has absolutely crushed it. So, personally, I think NVIDIA continues to just expand what's going on in the semiconductor world, and I think that will continue. That's a name that probably is in most of your portfolios through a mutual fund or an ETF on that. So those are some of the key sectors. Again, you want to be mindful of how much liquidity you need as an investor. You don't want to tile your money up in any one asset class. Certainly certain asset classes like technology or crypto have a much higher standard deviation, which means they can fluctuate a lot. So I have, many investors who have been like, well, hey, why aren't we in more Bitcoin or Ethereum? There was a time when we had a higher allocation, although it was still a small dosage. But we found that investors have a hard time stomaching the volatility. So you want to be thoughtful just in your own suitability. I mean, what is suitable for one person or organization may be different for another one on that. So I hope that's helpful. Again, those are some of the asset classes we like. And I think those will continue to do well. Again, in summary, as I wrap up here on today's show, I think a rate cut is all but assured for September, followed by a second interest rate cut. Could be in October. I would probably lean more towards December, just on some inflationary pressure that's we're going to see. Now, the whole world will be watching that. In fact, the equity markets and gold market have already really priced in a rate cut based on, again, only 22,000 new jobs being added to the economy in August of this year, well below the expectation. Again, that was 75,000 jobs that was expected on that. So unemployment's up, underemployment's up. What that means is we've got a weakening labor market, and we do have inflation, what we believe is ticking back up. Not dramatic, but enough to where rates are not going to come down too fast on that. We'll talk more as we get later into the fourth quarter on our outlook for 2026. I do think there's some strong economic wins at our back for 2026, and also more rate cuts to come next year. But hey, as we say, we just focus on what's in front of us. And right now, I think it's important just to be mindful of that as you're managing resources, thinking about how to allocate, diversify your investments in light of what's going on in the economy today. So if you want to learn more about our approach to investing, using values and an ethical focus on making sense of making money and helping solve some of the world's greatest problems while you invest for financial gain, we'd love to connect with you. And if any of this information, you feel like, hey, I'd like to know, how does this economic data, how does it apply to my portfolio? Our team at Wealth Builders Investments would love to connect with you. And you can reach us online, wealthbuilders.net. It's a great way to reach out. You can also email us at info@wealthbuilders.net. Be happy to visit with you. You want a consultation? You want to talk through, hey, I heard you on the show talking about the interest rate cuts. What should I be doing with managing my cash, or how should I be thinking about my real estate portfolio? Happy to visit with you on that. I hope this update was helpful for you. And again, we'll be back with more information on this. We'll do another show after the September 17th Fed announcement of what we believe will be a quarter point rate decrease, which will be helpful. We'll come back the week after that, give an economic update for you. So again, I'm Chad Frantzen with the Kingdom Finance Show. Thank you for joining us on today's program. Take care.
Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.